With chaos at the New York Stock Exchange.
Get back in there at once and sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's gone crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Financial Advisor at BIG Investment Services. That's BIG, Booth Investment Group. We're a full-service financial advisory based out of Dover, Delaware, serving clients all across this great country. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put the show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come. Trying to keep you up to speed with you and your money. And we're glad you're with us today. It is Friday, June 14th, 2024. Shout out to my friend Chandler and his lovely and ruthless pickleball playing wife. I had no idea a wiffle ball could travel so fast. I actually spent a little time looking up the laws of physics regarding the speed of light and molecular structure of wiffle ball plastic, and I have not been able to figure that one out. So let's go ahead and jump into the numbers. It was a bit of a mixed bag this week for the markets. Dow Jones was down 0.5%. The S&P 500 up 1.58. The NASDAQ composite, a lot of your tech and growth stocks up 3.2, and the Russell Small Cap Index down 1%. There's a lot to talk about as to what were the mechanics that drove the market action this week, and we'll jump to that in just a moment. Let's go over some of the other basics. The volatility index up 3.6% this week, so it pumped up a little bit from where it was last week. Still at a relatively low number, but it did bounce a little this week. Taking a look at long-term bonds as measured by the TLT. They jumped a lot this week, up 3.4%. And you can thank the inflation numbers for that. Again, we'll circle back around, talk about some of the mechanics, but inflation numbers drove bond values higher and rates down this week. And we take a look at the sectors, again, a big mix, but semiconductors, NVIDIA, and others just really driving the semiconductor index up quite a bit, up 6.2%, and technology as a whole up 5.5% this week. Everything else much more muted. How about that? I mean, utilities are flat on the week. Staples are down 1%, energy down 2%, financials down 2%, healthcare down 0.4%, industrials are down 1%, materials down 1%. Golly day, everything was either flat or down pretty much except technology. Gold was up 1.9% this week and silver up 1.2%. So I want to talk about this phenomenon for just a moment. I've got a few concerns about this market. It's really getting excessively narrow as far as what's pushing the market higher. I saw a report this morning, actually, from a friend of mine, Nick Rake, it's earnings scout, and do a lot of work with Nick and his team tracking S&P 500 earnings. And one of the things that he pointed out was that the index is up 2.9% month to date. We're talking about the S&P 500. It's up 2.9% month to date. 7.5% rise amongst the top 7 stocks in the S&P 500. 7.46% rise on the top 7 stocks, of which we own a couple of those. The other 493 companies in the index, the average decline is 0.7% month to date. So that's a really huge disparity there between 493 stocks of the S&P 500 down almost 1% on the month, but those top 7 stocks up 7.5%, given the index a 2.9% positive return month to date. That's a shockingly wide gap between those 7 stocks and the rest of the market. And we're seeing this lack of breadth throughout. I mean, small caps continue to disappoint. Now, we have some exposure to small caps right now because I think they are one of the most attractively valued asset classes in the world today. Let me say that again. One of the most attractively valued asset classes in the entire world. Therefore, we've been adding some to high quality small caps to position ourselves for what I think will eventually be a reversion to the mean. When you see a disparity so wide like this, it's very rare that we get a gap this wide between the S&P and small caps. It's only happened a couple times throughout history. And when it has happened, eventually there's been a reversion to the mean. And I think we'll eventually see that. When? I don't know. That's the question. I keep expecting and hoping it happens relatively soon, but it doesn't. So we'll have to see. Now, at the end of 2023, small caps rallied nearly 50% in an extremely short period of time. That's right, 50% in a very short period of time. So when they move, they will move, and we will be prepared for that to happen. In the meantime, we do have some of those top 7 stocks. I'm glad we do, because they have been on the move, and that's been certainly helping things out. And I should mention this too. I mentioned it last week. I'm going to mention it again. And if you don't know the reason why I'm mentioning this, you have to go listen to the podcast from 2 weeks ago. But just for the month, just month to date, Uber for the month is up 8.5%. ServiceNow is up 10.9%, and Shopify up 14.4% month to date. Those 3 stocks. And like I said, either take a peek at your holdings or go back and listen to that podcast at the end of May. So look, what's moving the markets this week? Inflation numbers and Fed Chair Jay Powell, okay? And you talk about a tug of war, but it's like WWE out there for those of you that are Gen Xers and know what the WWE was. I mean, we're talking like Hulk Hogan and Andre the Giant and all those good things. This is really insane what's going on between the actual data and the folks that are in charge of interest rate policy. And there was a major tug of war this week. So we got much better inflation data, and we needed it. You may know that I've been concerned about the uptick that we saw in inflation first quarter of this year. And we finally got some cooler data from both the CPI, the Consumer Price Index, and the PPI, the Producer Price Index. That was really good news. Cooler data on both fronts. The PPI, much cooler. And that's great. Those are wholesale prices. So really, really happy to see that. Unfortunately, Fed Chair Jay Powell and company are doing what they always do, lagging behind. And their commentary this week after their meeting, they held rates the same, but the commentary was very hawkish, very in the camp of forget about any interest rate cuts anytime soon. How about that? No, listen, that was our base case coming into this year. We talked about it on the very first podcast of the year. We wrote about it in our year-end newsletter as far as our outlook for 2024. I felt the biggest risk to the market was going to be the fact that the market was expecting 6 rate cuts, and we didn't really expect any. We thought that we'd be lucky to get between 1 and 3, and if we got those, it would be towards the end of the year. Well, here we are in June, halfway through. There have been no rate cuts. The Fed is now talking like, not so sure we're going to do any rate cuts at all this year. One or two of them said no rate cuts at all next year. Now, remember, this is the same group that was not even thinking about raising interest rates at the end of 2021, and then went from 0 to 5% in the course of 12 months. Now these folks are also not thinking about cutting rates anytime soon, and the concern that the market's starting to sniff out. And I'm seeing the market, I think, sniffing this out based off the lack of breadth, the weak performance on some of the different areas of the market. I think that it's starting to sniff out that the economic data is weakening, and it's probably time for the Fed to start to loosen up a little bit on interest rate policy. What happens inevitably, it's happened pretty much every single time the Fed's ever raised rates, is they've always cut too late. They wait too late before they make a move. And by the time they make a move, by the time they actually see things weakening to the point where they're comfortable, it's too late. Our economy is not a race car. It is a big cruise ship. It doesn't turn on a dime. It takes some time to change course. And if you wait too late, you miss it. I think I have mentioned, I've been a little concerned about some of the economic data. I've been in the camp that the Fed should just hold tight. I've been in that camp all year long until just the last couple of weeks. Last couple of weeks, I've felt that maybe it's time for the Fed to really start thinking about a cut or two, give this economy a little something to sink its teeth into, because we're seeing cracks, a lot of chinks in the armor there. Now, next week, we're going to get some more data. We're going to get a lot of manufacturing data. A lot of PMIs are coming out. These are the manufacturing indexes. We're also going to get retail sales, and that's a big one. There's been talk that the consumer is weakening. Now, there's been talk of that, but when you look at all the earnings reports, it's really like those that are executing and those that aren't. So I'm not so sure if the consumer themselves are weakening to that point, or it's just poor execution by some of the retailers. But retail sales numbers come out next week, and I think that's going to be an important one to watch. And we have a slew of other economic data as well. So far, companies that have been reporting earnings that have included this most recent quarter have been doing pretty good. The earnings that have been reported so far have been good. And I think that right now, for this market to go higher, we need to see earnings really start to accelerate to some extent. Earnings season's still a couple weeks away. And until we start getting some of that data, I think that the market's going to be in this no man's land because it's looking kind of expensive. I mean, right now we're getting around 22 times or so on the S&P in earnings, and that's a pretty expensive valuation. So we really need to see earnings expectation increasing in order to support this valuation, or you need to see rates coming down to support high valuations on the stock market. And Powell & Company made it pretty clear this week that we shouldn't expect rates to come down anytime soon. Now, the good CPI data and PPI data, the bond market did its own thing, and that's why you saw the TLT up 3.5% this week as bonds went up in value and rates came down in the bond market because they're responding off of the actual data, not the Federal Reserve. So we'll see if the Federal Reserve does come around and join the party here in the next month or two or three. Hopefully, maybe by the fall, they'll make a move. The market's kind of pricing in that first rate cut maybe in September. We'll see. But that's what I've got for you this week. So between now and next we meet, as you're thinking about your future, your long-term goals, all the things you want to do with you and your money, maybe it's start your own LLC and not offer any equity to anybody. Just do it all on your own. Maybe it is retire a little early or pay for that college education or that major wedding. You know what your goals are. Don't just dream about them. Don't just think about it. Think BIG, and I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll-free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.